What's going on, everybody? Welcome back to the channel. I appreciate you stopping by, spending a few minutes of your time here with me tonight. Um, Tonight, I want to talk to you, obviously, about easy continuation scenarios. All right. Now, when I say easy, I mean easy, bro. You don't need that much information to be able to understand this, but there are some key things that you need to know. And that's what we're going to be going over in this video. All right. And stick with me, okay? Because I promise you, this is powerful stuff. But at first, when we get into it, you're going to start saying to yourself, what is this, man? Am I wasting my time? This shit's so simple. I already know all of this. I don't need this information. I already have this information. But I promise you, if you can follow this video, if you can see it through to the end, this should impact your trading. All right. This is one of the most valuable insights I have ever had into the market over my time of trading. All right. And I mean that. I'm not just saying that to get views or to keep you on the channel. All right. I don't give a shit about this YouTube stuff, bro. I'm here to help you. I care about you. I care about your trading. All right. I care about my own trading. That's what we're here for. Now, sometimes we take information for granted. We say to ourselves, well, that's obvious, right? And then we disregard the obvious information. But that obvious information is what's going to help you, all right? That's the type of stuff that you have to return to when you get stuck, all right? A lot of people get stuck and then they go on a wild adventure and try to find a bunch of new information. But a lot of the times you're stuck because you have taken something for granted. You've basically forgotten about it, pushed it off to the back of your mind. All right. And when you go back to the basics, you start to see things that you've missed, right? Or that you've forgotten about. And now that you remember it, it changes your entire perspective and you're able to make progress again. All right. So do not discount this information. It is extremely valuable. All right. Now, first things first, and we've talked about this so many times, and that's because I feel like I cannot overemphasize this. All right. We've talked about this a lot of times, but it's important to understand this simple fact of the market. And when I say fact, I mean fact. I mean a non negotiable, bro. Nobody can argue with what I'm about to tell you. All right. It's just a simple fact of the market. The fact is that 99% of the candles on your chart, regardless of time frame, have wicks on either one or both sides. All right. Now, what this tells me, right, is that if we can identify something like this that's so constant, the fact that we have wicks on almost every single candle, okay, that tells me that the market has a certain tendency, okay? On your charts, there's a certain tendency here, and that's what we're going to be talking about how to take advantage of certain market tendencies. This is just simply the way the market moves, all right? And by concentrating our efforts on understanding this for real, we can start to take advantage of these market tendencies and make our trading very simple and very profitable, all right? So let's dig deeper into this idea that every candle on your chart has wicks. All right. Now, with everything in life, there are layers of meaning. Okay. When someone tells you something, right, or shows you something, or you discover something for yourself, there's always multiple levels of meaning. And that's true about these wicks as well, because all of us should know by now, right, that the upper wick on a candle represents the high price of whatever time frame that you're looking at. For the sake of this video, we're going to just say that all of these are daily candles. We're looking at a daily chart here, okay? So we know that every upper wick is the high of the day, and every lower wick is the low of the day. But that's only the first meaning. That's only the first level of interpretation here, okay? The wicks actually give us a lot more information than that, okay? By exploring this deeper, we can understand the market much deeper, okay? So let's just look at this first candle. All right. We know that the body, the upper body of this candle is the opening price for that day. And the lower body of this candle is the closing price of that day. Okay. So, what these wicks are telling us is that at some point here, right, this market opened, and at some point, price traded above the opening price before ultimately selling off and giving us a lower close. And this lower wick here shows us that at some point the market came down, put in a low of the day level, and then pulled back and closed above that low of the day level. All right, so you see, there's another layer of meaning to these wicks. Now, when we combine two candles, we get even more information. So let's look at this first daily candle combined with this second daily candle. All right. So all the same information is there. We know this is the high of the day, the low of the day, the open price, the closing price. And we know that this upper wick is a portion of intraday price action that took place above the opening price. And this lower wick is a portion of intraday price action that took place below the final closing price of the day. Now, when we look at day two, it's the exact same thing. We have a candle, we have a opening price, a closing price, a high of the day, a low of the day, right? But now when we look at this wick, that wick isn't simply a portion of intraday price action that took place above the opening price. Now it's also a portion of intraday price action that took place above the closing price of the previous day. And what that tells us is that at some point during this day, price traded above the opening price of the day. It traded above the closing price of that day. So, in other words, at some point, price traded back into the previous day's open and close range. Okay. This day reached back up into the previous day's range before ultimately giving us a lower close. All right. You understand? And this is just how the market tends to move. The market just doesn't move in straight lines. It doesn't go straight down, right? It's always going to have an impulsive move and then a corrective move, an impulsive move, then a corrective move, or it's going to, go in one direction, right? It's going to drop and then pull back, or it's going to go up and then pull back before going higher or before going lower. All right. Now, this is the stuff that I'm talking to you about. All right. Now we can see that these wicks show us a lot more information than we give them credit for. All right. And because this is such a common occurrence, we would do well to understand these wicks in and out. All right. Because think of it. If you want to sell the market on day two, your ideal entry is going to be where? Right? It's going to be inside that wick. If we look at day three and we want to buy this market because it's a bullish day, our ideal entry, excuse me, is going to be in that lower wick. Right? If we can buy it inside of this wick, we're obviously making money by the end of the day. Okay. Now, how are we going to do that? Well, it's very simple. Once you understand what's going on, I'm going to give you some general rules for this. Okay. So, we're talking about continuation trades. When you're looking at the daily chart, it's not uncommon to have consecutive bearish days and consecutive bullish days. So we might see two bearish days in a row. We might see three bullish days in a row, followed by three bearish days in a row. Okay, this is not an uncommon occurrence. You will see multiple days all going in the same direction, and each of those candles is going to have wicks on one or both sides. All right, so if you have been paying attention, what this is telling you is that once you have a day that closes green, this is how simple it can be. We've had two red days, then we have a green day. Now that we see here, we've got a green day, we can form a very simple directional bias for day four. Okay. We can say the previous day closed bullish. So I'm expecting the next day to also close bullish because it's not an uncommon occurrence to see consecutive days closing in the same direction. All right. So once we come to day 4, what do we want to see in order to take a long trade, in order to take an easy continuation trade in the bullish direction? We want to see price open up and wait for it to, at some point during the day, trade below the previous day's closing price and reverse and head in the opposite direction. And when it reverses, that's when we're going to take our entry. Okay. Now, also understand this. If you've been around trading for a while, you've probably heard of multiple time frame analysis, right? Multi-time frame analysis, where we're looking at the daily chart, the 4-hourly chart, the hourly chart, the 15-minute chart, the 5-minute chart, and the 1-minute chart. And we're waiting for all of these charts to align and go in the same direction, all right? But if you're doing that, you're almost forced to take a late entry, all right? Let's just look at this. When we see this candle, okay? When this day opens and it begins to trade below the opening price, as it's trading below the opening price, okay, it's a red candle, right? While it's putting in that wick, while it's forming that lower wick, it's a red candle. But once price comes back up and starts trading back above the opening price, now the candle flips from red to green, and now we are in the continuation. The continuation has already happened, okay? At some point down here, your 1-minute chart has flipped from red to green. It's went from a downtrend to an uptrend. Your 5-minute time frame has flipped. Your 15-minute time frame has flipped. Your hourly chart has flipped. Your 4-hourly chart has flipped. And then finally, your daily time frame flips. And if you're looking to enter after that candle flips from red to green, you are late. So we hear people talk about a top down analysis, but we want to be able to enter this market preemptively before the daily time frame flips. We want to get in it when the 1-minute time frame flips, or when the 5-minute time frame flips, or whatever your entry time frame is. Okay. So here is some information that's going to help you to determine when this is happening. Okay. Each one of these wicks, okay, right? On this green candle, for example, this, and on every candle, but on this green candle, this day 4, that lower wick is the low of the day. The upper wick is the high of the day. Those highs and lows of the day are what we call here peak formations. Okay. This is a peak formation that is locked in place, and then we go the opposite way. Those peak formations are typically put in place in a session opening window. All right. So using Eastern Standard Time, we're looking at this peak formation to be put in place between 8 and 11 p.m., 2 and 5 a.m., and 8 and 11 a.m. Okay. And remember, these are market tendencies. It doesn't mean that it has to happen like this, but in a large majority of cases, it is in these timing windows that we are going to see these peak formations locked in place. Okay. Now, you can use this information to your advantage while you're trading, okay? Once you zoom in on your lower time frames and you're looking for entries, if you can remember all of this very simple information, it's going to help you take some great entries into the market on these easy continuation trades, okay? And now I have some chart examples to go over with you. Just a couple chart examples to make sense out of all of this, all right? And I'm hoping that it really helps you out going forward from here, forming your whatever, your directional bias, your trade thesis, and also determining where your entries into the market may be. Okay. So let's look at this DJ30 chart. All right. You can see here, this is the last week that we just had. Okay. Here's Monday, Tuesday, Wednesday, Thursday, which is when I took this screenshot, early Friday. So Friday's not on there, but we don't need it. All right. We have the closing price of each day marked off. So this was Friday's closing price here on Monday. Monday's closing price is projected on a Tuesday. Tuesday's closing price is projected on a Wednesday, so on and so forth. All right. Now you can see here that Friday gave us a lower close. As soon as that happens, I say to myself, Monday may also give me a lower close. If I want to see Monday give me a lower close, where do I want to sell this market? Right? Logically, if I can sell on Monday anywhere at or above Friday's closing price, by the end of the day, I should be in the money because I'm expecting a lower close, right? A lower close than the open. Remember, the market can only do three things, right? Stacy says breakout, pullback, continue, breakout, pullback, reverse, breakout, pullback, enter a trading range. I say it's slightly different, and it's one of these things that has multiple layers of meaning. Okay, I love the way Stacy says that, but another three things that the market can do, right? On any given day, you can expect the market to do one of three things. It's either going to give you a lower close than the open, a higher close than the open, or it's going to close relatively equal to where it opened, right? So if Monday is going to close lower than it opened and I am selling it above the open, I should be making money, right? Because we're expecting a lower close. So when I come to my charts on Monday, what do I want to see? I want to see this market pumping up above the previous day's closing price. So above Friday's closing price, which is this yellow line, and it's pumping up going into that New York session. All right. And if this is going to form my wick, I want to see a peak formation locked in place. And then we start going lower to give that lower close. And that's exactly what happens on Monday. We're here in the New York session. We're at the high of the day. We dump down. We pump up there one more time, taking out the previous high of the day, reversing. We break through all these levels. Bam, that peak formation is being locked in place. Now, because I have a directional bias, I have my short trade thesis, I'm thinking to myself, all right, we very possibly are locking in the high of the day here. So I feel pretty confident in taking my short entry here and holding until we drop down and get that lower close. All right. Now, check it out. If this was a daily chart, if we were looking at the daily chart, the entire time that this market is trading up above that previous day's closing price, right? This candle is green, okay? The daily candle is green. As soon as it drops down here, it has flipped from now it's not a green daily candle, now it's a red daily candle, right? All of your other time frames have flipped red, but look, you're a little late for your entry. You could be entering up here if we were able to zoom in on a smaller time frame, which I don't have those screenshots for, but you can feel free to go and look at this on your own. If you go in on a smaller time frame, say a 5 minute or even a 1 minute, and you're looking in that timing window, this is an index, so instead of 8 to 11, we're looking at 9:30 to 11. So if you go back and you look at a 1 minute chart from 9:30 to 11, you're going to see this happening here, okay? You're going to see this peak formation being locked in place, and at some point you will see an opportunity to enter this market in line with your directional bias and your short trade thesis, okay? Now, the next day, Tuesday, gives us a higher close. So excuse me, maybe you don't trade that day. But as soon as Tuesday gives you a higher close, now I would be saying to myself, okay, Tuesday closed higher. So maybe Wednesday will close higher. That gives me a directional bias. Now I know that I'm looking for a long trade, right? And I talk to you guys about this all the time. If I'm looking for a long trade, and before I'm looking for my entry, I need to have a target in mind, okay? So this high from Tuesday would become my potential target for the following day, all right? And if I have a long bias, where's my ideal entry going to be? My ideal entry if I'm expecting the market to give a higher close than the open, if I can buy this market anywhere at or below the previous day's closing price, logically, I should be in the money by the time we get that higher close on the day, right? And you can see here we're dumping down below Tuesday's close in London. We pull back, we dump down going into the New York session. We're back retesting those London lows. We can't go any lower. We reverse, boom. Okay, we take out that target. There's your easy long trade, your easy continuation trade from Tuesday's uptrend. Okay, easy, easy, easy stuff here. All right, and that's all you're doing. That's it. You're just waiting for the right opportunity. You're not going to be doing this every single day. You want to wait for the cleanest opportunity that you can see. Like Monday here is super clean, right? We have the down closing Friday, all right? And then we're pumping up. We got an easy peak formation to identify, even on this time frame, which, what is this time? On a 15-minute time frame, right? As soon as we break through this level, you treat it as like a death line. You'd be entering like right here and then holding it, right? Very clean, all right? This day, very clean. We have a very clean retest of the London lows, rejections. We got pin bars going down here. Okay, we're engulfing candles, a W here at the low of the day, big W here. Everything is there. It's a super clean trade. You're taking it long from the low of the day. And on Monday, you're going short from the high of the day, which is exactly what we're trying to do, right? We're not trying to sell it from near the low of the day. We're not trying to buy it up here at the high of the day, but that's what a lot of novice traders do because they don't understand this information. They don't understand that often before the market sells off, it's going to pump up, right? And often before the market has a crazy bullish run, it's going to dump down. It's going to get traders shorting that market, and then it's going to explode in the opposite direction. And that's what Stacy's strategy is built around, right? Inducement, liquidity sweeps, triggering higher time frame traders into the market and trapping them on the wrong side of the trade. That's what Stacy's shit is all about. And that's what I'm showing you here, just a different way to use it. And you can see we're not breaking daily levels. Monday doesn't break Friday's high and then reverse, does it? No. Tuesday doesn't break. Wednesday doesn't break Tuesday's low and then reverse, does it? No, it doesn't. But we are still able to take these trades understanding the dynamics of the wicks, how those wicks are forming on the candles, what those wicks represent, by understanding the timing windows and when peak formations are likely to be locked in place. This is powerful, powerful information. And I'm not giving you a cookie cutter type of step-by-step sort of approach to this. This is something for you to think about, something for you to research, something for you to go on your charts and look into for yourself so you can have powerful ideas come to you naturally, okay? But if I was to give you some sort of step-by-step approach, it would be form a directional bias, which can be as simple as saying, okay, the previous day closed bearish. So I'm expecting the current day to also close bearish. There you go. You have a bearish directional bias, right? Because of that, you can form a trade thesis. You want to take this market short in either the London session or the New York session after we pump up above the previous day's closing price, right? What's the next step? Wait for the peak formation to be locked in place in a session timing window. You're just on standby. You're not doing anything until you see this potential peak formation being locked in place in your timing window. Once you see that, you follow your entry criteria and enter that market. You should have a target in mind, okay? So on this day, if you're entering, your target could be the previous day's low, or it could be these earlier lows, probably, what is that, the London session, okay? So you're targeting the London session lows for a very easy short trade. You're taking most of the money off the table once you hit that target and leaving a runner to go, maybe to the close of the day or to whenever you're comfortable with, right? Bam, there you go. Now, in this scenario, you're looking at the market on Wednesday. That's day 3 of the weekly template. Tuesday gave you a higher close. You have a clear target from this high. Now you're saying to yourself, okay, boom, I have a bullish directional bias on the day. If I am expecting a higher close than the open, if I can buy this market anywhere at or below the previous day's closing price, I should be doing well for myself. All right. And all you're doing after you have that directional bias and a long trade thesis, you are waiting for that peak formation to be put in your session timing window. For me, I'm trading New York primarily. I maybe take a London session trade once a month, but for the most part, my work is done in the New York session. So for me, and that just makes things simple, right? So for me, I'm looking for this peak formation to be locked in place in the New York session. Where are the 3 levels we enter from? The high of the day, the low of the day, or the previous day's closing price. All right. With all of that information, as soon as you see this peak formation potentially being locked in place means we have the reversal pattern and the market engulfs and starts going the other way. You have your potential target here. So you're entering the market, putting your stop loss, putting your target, and walking away from the screen. Okay. Or you can sit there and monitor it just like we would maybe do on Monday, right? Take most of the bulk of your position off and let the rest run. Here, take the bulk of your position off, secure the bag. No one ever went broke taking a profit. So take the profit and let the rest run until it starts to pull back, until you're uncomfortable or until you make enough money or until you see, a reversal pattern at the high of the day. Then you close down your trade. You're good as gold, right? You understand what I'm saying to you? Now, when we look at this chart, which is the US dollar, Canadian dollar, all right, we have a few different things going on. You can see here all of these days closing lower, right? Or at least most of these days closing lower, all right? And then suddenly down here, we get our first green day. Now you can see you could bypass all these other days while you wait on this signal, all right? But while this market is dropping, you will have the same directional bias. You say, okay, whatever day this is closed lower. So the next day I have, a short bias. If you're only trading the New York session, you had no trade that day. Here you're expecting a lower close because this day gave us a lower close. Maybe you could sneak in there in the New York session, right? But it doesn't look as pretty, so you don't take it. Because this day closed lower, you're expecting the next day to close lower. And look at that. There's our closing price. Market pumps up above closing price, reverses, locks in the high of the day, starts going down. You take a trade on that day, right? This day gives us a higher close, so you would have a long bias the next day. But unfortunately, that trade doesn't pan out. We are dumping down below the previous day's closing price. We're pulling back against the previous day's move, right? And it looks like it wants to maybe going into the session timing window, but it doesn't do that. It comes up, reverses strongly, and continues to go lower. So you don't have a trade that day. Then here, this day, takes out the low of the previous day and gives a higher close. There's our first green day signal day. So the next day, we're thinking to ourselves, all right, I've got a long bias. What do I want to see? First, I want to see price dumping down below the previous day's closing price and putting in a low of the day peak formation. And that's what we do heading into whatever timing window this is, either the London session or the New York session, whatever. You have a target from the high of the current day. All right. We reverse here. You're taking your entry and you're getting in that wick. Okay. You're getting in that wick because you know exactly what you're looking for. You take that long trade at or below the previous day's closing price, which is that yellow line. So either down here or you're getting in when the daily candle flips or whatever you want to say. You hold it and you're good as gold. All right. But this is very simple information, and it's utilizing certain tendencies that the market repeats over and over and over again. You understand what I'm trying to say to you? We can use this information to our advantage. The more you focus on this and look at your charts, the easier it's going to be for you to recognize it. All right. Now, none of this is a get rich quick scheme. None of this is something that's going to allow you to come to your charts every single day and trade and make money. What I'm telling you is that there will be days where the market behaves in a very specific and easy to recognize way once you get used to what you're looking for. Once you know exactly what you're looking for, then it should be very easy for you to sit back, sit on your hands, wait, and let the market bring a trade to you that you can see, that becomes obvious to you over time, because that's where your focus is. Okay. Now, this is one of the simplest ways I have found to take trades. Like I said in the beginning of this, it's one of the most powerful insights I've ever had. Just looking at the market and observing how it moves, generally speaking. All right. If we were to go look at a daily chart, like let's just go do it right now. So you can see what I'm saying. Let's go look at gold on a daily chart. Every single one of these candles has wicks on one or both sides, right? And you can see it's not uncommon to have multiple green days in a row, multiple red days in a row. And look at this wick, right? So we stretched all the way back up here before dumping down, right? Then we have 2 red days right here, 2 green days, 2 red days, 3 green days, 3 red days, a couple janky days, but 2 red days, 2 green days. All right. 2 green days here. So it's not uncommon, right? It's not that bad of an idea to just say, okay, yesterday closed red, so today's going to close red, or yesterday closed green, so today might close green. And if it is going to close green, I want to see it dump down below the previous day's closing price, reverse in a session opening window, and go higher, right? You understand what I'm saying? So anyway, man, I hope that this video makes sense to you. I appreciate you being here. And until next time, I hope you continue to free your mind.